Well, this is a great one. I taught this to some of you. This is the yield curve. This is another thing the Federal Reserve has written about. One of the most dominant buy and sell signals in the marketplace. The yield curve is simply the difference between short-term yields and long-term yields. If you think about it, when short-term interest rates are higher than long-term interest rates, people are demanding higher interest rates now because they're worried about the future. And normally, as we go out in time to maturity, rates are higher, so this yield curve is low rates on short-term paper, high rates on long-term paper, and this curve is an upward hill curve. That's normal. It tells us that big money out here is expecting the markets to be okay. They're not worried about the markets. But the yield curve the other way, the inverted yield curve, when rates are high on a short-term basis, short-term time is down here, and they're lower as we go out in time, that tells us big money is really frightened of the economy. They think the economy is bad. And so they demand more money for short-term notes than for long-term notes. That's the yield curve, fundamental to how the markets move. And it's another one of those indicators. Until I started talking about it a couple years ago, nobody knew about it. So the yield curve, a steep positive curve, what we saw going up, indicates investors expect strong future economic growth. The inverted curve, when it's going down, means investors expect sluggish economic growth. They want more money now for their money. A flat indicates investors are unsure, and the market doesn't like uncertainty. We can actually use this indicator to predict recessions, and if we can predict recessions, we can predict stocks. So, and the yield curve is negative. The probability of a recession is 60%. When it's negative by 2.4, we're going to be in a recession. The probabilities of being in a recession is 90%. And again, these are not my numbers. I didn't come up with this. The Federal Reserve came up with this. This is their paper. This is their data, not my data. So the yield curve is really important to help us understand recessions. And the yield curve is in this area. There's a 0.02% chance of a recession. Oh, those are good odds for a bull market, wouldn't you think? If the chances of a recession are 0.02 or 0.76, we're just not going to have a recession in here. It's not going to happen. So we can use this to help give us a sense of timing for the stock market. Question?
Yeah, I'm sorry, which treasury yields you? 30 minus 10?
I'm going to give that in just a moment. We'll show you an easy way of doing it. So these yield curves have preceded 7 of the last 7 recessions. Do you think this is a tool you like to follow? Oh yeah, right? Did you know about it 45 minutes ago? No, people didn't follow it. But now you're starting to understand how markets move. They don't, in my view of the world, they don't move because of charts and all these things that we read about in all the books. They move because of these conditions of the marketplace. And it's been full cycle for me to start 53 years ago reading books that said price can predict price. And I should have realized my college professor said that you cannot predict A with A. Anybody else take logic in college? You can't predict A with A, can you? You're supposed to predict B, C, and D will help you predict A. But we've been trying to use price to predict price all these years. And that's a fallacy. So I've come all the way from being a big-time technical guy to saying, yeah, there's a place for technical. There really is. But the conditions cause things to happen. Markets move from this point to this point because of conditions. Some economic yield curve, interest rates, money supply, decennial pattern, some condition causes those things to happen. But it's not that easy, unfortunately, in this game. We have emotions. People got emotional about money. Anybody got emotional about money here? Oh yeah. Look at everybody laughs, so you get emotional. And you're emotional not only because of money, but because whenever you say, I make this bet, or this is what should happen, your ego is also at risk. And we're all hardwired to protect our ego, so we get emotional about our decisions. So we have an emotional commitment to something and a financial commitment to something, we get very emotional. So prices move like this, I can do this with these, along the way to get there. Those are the emotions of the day. Okay? So traders trade the emotions, but if you know we're going to go from here to here, you understand which side of the emotions to trade, don't you? Oh, we're in a bull market, I want to buy dips, basically. Or if I am a short seller, not for long. So the markets move for conditions, but emotions are what short-term technicians need to focus on, is the emotions of the day. If you would, Harry? So here's the probability of recession predicted by the Treasury spread. When that Treasury spread gets high, about 30, we didn't get a recession then. We did here, 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 and here. You've got to follow this stuff. Because if we have a recession, that means people stop buying things. If people stop buying things, companies stop selling things. If companies stop selling things, they stop earning money. If they stop earning money, what happens to the price of the stock? It goes down. So recessions drive the market. And we've been focusing, at least maybe not you people, but I have. I focus on the wrong thing. I focus on thinking that the stock market could tell me when it was ready to go down instead of saying, duh, recessions cause markets to go down, and I don't want to be involved in stocks when there's a recession. Please.
Larry, how important are mutual funds when it comes to driving the stock market?
I don't think mutual funds are very important on a long-term basis to driving stock prices. Mutual funds don't have a particularly good record. Well, obviously, by the end of the day, you'll have a much better trading strategy than they have. Because I've advised some of these funds, I wish you could hear some of the phone calls I've had with the funds where they call me up right at the bottom in 2003 and were rapidly angry with me for telling one of their customers to buy stocks the day of the low. How can you possibly tell my cousin to do that? You're telling him to buy stocks right now. This is the whole, they're just like us. And if you look at mutual fund performance, what does it do? On average, they don't beat the markets. So I'm not really too worried as some of the funds, some of the hedge funds, I like to follow their buying. We'll look at that later today. But on average, I don't think they run the markets. So the impact of that yield curve, if you're an investor and that yield curve is inverted and flattening, your average 3-year return is minus 31%. Think you want to be invested in the market when the yield curve is inverted or flattening? You want to lose 31% of your money? Probably not. You probably want to be invested when it's positive and flattening and you average 17.4%. Look at the difference between that. Almost a 50% difference between when you're in the market based on this fundamental condition or that fundamental condition. How cool is that? To know, yeah, I really want to be involved in stock. Throw out the newspapers, don't listen to any of that stuff right now because we're in a condition of bearish or bullish, whichever that happens to be, as opposed to trying to figure out what the heck the stock market is trying to tell us. Now, what's really interesting to me about this, you can see the impression. This is when the yield curve is positive. Those are profits. Down here, negative, but this is the significant part. That's Japan. This is the United Kingdom. This is the S&Ps, and that's the NASDAQ. This is a worldwide phenomena. This yield curve isn't just about America. It's about China. It's about the UK. It's about Europe. It's about Japan. Yield curves predict all economies of the world. And the economy is essentially cause of stock market rallies or declines. So this isn't just like a little thing for America. I was just in China earlier this year, and the same things happened in China at the stock market recently. Rates inverted on their rates. And so lo and behold, what happened? Stock prices come down in China, and now stock prices are going to start to rally in China. So it's a very important consideration for us to have, is to be able to look at what big money is thinking. Are they bullish? Are they bearish? And we can do that by looking at the yield curve in the marketplace. Question?
The S&P is the only one that shows...
I'm sorry, I can't hear you.
The S&P is the only one that shows positive for the inverted, even though it's much, much less. Is that because it's being used as a hedge?
If you look closely at the chart, you'll see there's when the yield curve was inverted. The S&Ps made a little bit of money, but that was from 1970 to 2001. Once you put in 2001 and the 2007 bear market, that drops down. A great long-term indicator. Basically, you can use this yield curve in a couple of ways. When the yield curve is less than 0%, you want to be long commodities and gold. Now, right now, the yield curve, I'll tell you, is positive and been rallying. What's happened to commodities? What's happened to gold? There you go. Now, the gold bugs are upset because they think it's being manipulated. No, it's reality. We're in a positive yield curve, and so you would not expect commodities to go up or gold to go up. When will we have the next big commodity bull market? Well, there's your answer, isn't it? When the yield curve is 0 to 2%, long U.S. and foreign stocks. When it's yield greater than 2%, bonds really rally, and so do REITs. So this yield curve is such a cool indicator because we can use it not just for market timing, but we can use it for where we should be with our money. When to be in gold, when not to be in gold. There's a time to be in gold, just not now. Hasn't been for 4 years. Getting close, we're just not there yet. Now, the yield curve can also be used to predict the future. It's a great indicator. The yield curve is this kind of greenish colored line, and it's projected 2 years in advance. When I took this clip, it was projected 2 years in advance. This was November 2014. If you go back and look in your chart, November 2014 was a significant low in the market, and away we went screaming to the upside. The yield curve predicts that. The yield curve bottom just at the low 2 years in advance of the 2009 stock market low. So the yield curve, if we look at the annualized rate of change of the yield curve, it will help you understand when we are at significant stock market bottom with a 2-year viewpoint. To the day? No, it's not going to call it to the day, but it gives you a perspective of, we can understand now. Notice how stock prices, the dark gray line, move pretty much in sympathy with the yield curve, the annualized rate of change of yield curve creates the annualized rate of change of stock prices, so we have a leading indicator of what's going to happen. All the technical stuff just says what happened now. It's up to date to today, but it doesn't give us a clue about the future. Only cycles and fundamentals can do that. Gary?
You said that it was projected forward
2 years.
2 years.
2 years, so we have a 2-year projection. Okay, here's the yield curve. Now remember, the yield curve coming down is negative, right? Remember that? Okay. Here's the yield curve. Is the yield curve coming up or down? Down. That took place right here in 2000. What happened to stock prices? Oh, went down, didn't they? I wonder what it looks like at the low in 2002. In 2002, look at the yield curve. Is it up or is it down? Up. Do you want to buy stock? Yes. Do you want to buy gold? No. Stock market low. Big bear market started here. Would the yield curve been of any value to us? Oh, look at that. Yield curve is down and flat at the peak in 2007, 2008. At the low in 2008, 2009, our next chart, look at the yield curve. We've been coming up. And we're at a market low. This is where it gets really interesting. Remember that dreaded triple top that the scientists were predicting? We'd rallied up here and we started to come down here. The technical triple whammy sell signal. Our next slide, if you would, Harry. Oh, there it is. We should sell short. Oh, wait a minute. The yield curve is sharply higher. Investors are not worried about the future. But every technician in the world was getting sell signals, and everybody was worried, that dreaded triple top, whatever was happening. But the fundamental conditions, the yield curve was sharply higher. You don't want to buy gold, you want to buy stocks. We're in a stock market, in a bull market rally. And indeed, look what took place. I know what you're thinking. What's it doing today, right? We'll teach that at the high price seminar next weekend. It's not going down. It's suggesting that we're not close to a bear market. Maybe there's something else that's predicting a bear market, but the yield curve isn't. Unemployment isn't. The TED spread isn't. The anxiety index isn't. The Diebold index isn't. I don't know what side I should be on, but it sounds to me like probably we're going to expect prices to continue going a little higher. Question? Pardon? TED spread is the difference between Treasury bills and Eurodollar spread. Okay, so that's the yield curve. It's a great long-term tool for us to give us a sense of what markets to be in and when to be in stocks and when to be out of stock. Now, it's not a precise timing tool because in this decline, as we started to come down, we started to get a bullish yield curve in here. So it just says get ready for it. It's not a timing tool. We're going to get to other timing tools. But when it's bullish and I have a technical timing tool, that's when it all comes together for me. That's what I'm really looking for in the marketplace. Please, question.
Yeah, so Larry, you said you take a spread. Which Treasury notes are you using to get a one-figure spread?
There's a lot of, the question is which note do you use? There's a lot of different notes you can use short-term, but let's make it real simple for you. You can pull this up on the internet and you can see the red line yourself. The work's all done for you.
Yeah.
If you go to this website, stockcharts.com, it's all there. So you don't have to worry, they've done it for you. But we're going to use the short-term 3-month bills versus the 10 years.
For a forecast spread,
Right.
was more in line with the question.
Just almost any short-term versus long-term will work. But to simplify all of it, so you don't have to do all the work, stockcharts.com, it's there for you for free. You can click it tonight when you go home. You'll see if there's the yield curve up or the yield curve down. You can see how the yield curve moves along as stocks top and bottom. So you don't have to worry too much about this because most of you don't want to take the time and do the math to keep the yield curve data. So there it's all done for you. How nice is that? Huh?
3 months?
Yeah, usually 3 months. I think that's what, actually in theirs you can use a couple of different time periods. But the one they have set is the one I use because I don't want to have to get buried down in a bunch of data. The red line has done really well. I'm happy with that. And if you wanted to get more in depth in that, then read that Federal Reserve paper that we cited earlier about interest rates and spreads, and they get more into depth in that paper as well. You can take it out, all this stuff. You can make a career out of just a yield spread. But at my age, I don't have time for another career. I just need that little red line. Is it up or is it down? That's all I want. Please.
Larry, what was the source of the unemployment data?
The source of the unemployment data comes from the Conference Board. The Conference Board is an economic group that puts out a lot of economic data. We obviously keep it. You can subscribe to it. That's how I get it. You could also look at any of the employment reports. We'll show another one in a little bit. Just generally just think what's going on with employment. Right now, employment came out, what, a week ago? Was it up or down? It was up, right? Not as much as everybody wanted, but it was up. So we know that index is still going higher. When you hear a couple of months is down, you better start looking at employment numbers. There's a question here. Can you trust the numbers from the government? Well, of course. Of course you can trust numbers from the government. And there's a bridge in Brooklyn for sale. Yes and no. I mean, we don't have any choice. You know, it's their game, it's their numbers. But these are Federal Reserve numbers. And I think that they're okay. If you are more conspiratorial than I am, and that's being very conspiratorial, by the way, there's a group called Shadow Stats, and they have their version of unemployment and inflation. So you could look up, I think it's Shadow Stats or Shadow Stats, and you can go there and look at their numbers. But it's all relative. So by and large, I think we're okay with the Federal Reserve numbers that are reported. I mean, all these guys got elected, they want to make it look better. Nixon wanted to make inflation look lower. LBJ wanted to make unemployment look better. Obama wanted to make the economy. They're all trying to play their game. But on balance, I think it averages out. So, and again, it's the only data we have, isn't it? I'm better than looking at open interest in S&P 500. It's a little more reliable data. Okay, we'll look at another chart and then we'll take our first break. This is the consumer opinion. That when people are really negative, you think that's a good time to buy or a good time to sell? To buy, of course. Of course, it doesn't feel like a good time to buy, but if we look at consumer opinion surveys again from the Federal Reserve, oh my gosh, they have so much stuff for us there. And when everybody is very negative, those 1990, 1982, the 1974 market low, those are great times to be a buyer. The 2009 market low, again in 2011 market low. So we really want to look at opinion. It's not as good to call market tops because, as I showed you, market top by rallying, going a little bit more, keeping the party going, keeping the party going. So you get a lot of early peaks in this index because this thing just keeps going and going until one day it falls apart. Bottoms are boom, boom, quick. When everybody is negative, you want to be a buyer. And you could use this consumer survey or the one from the University of Michigan or whatever you want to. The only time they don't work for sells, they work for buys. When everybody's really negative, they're afraid to buy, they gotta buy. In our world, bad is really good. And that's hard to cross that emotional barrier. When things are really bad, we gotta get so excited. And when things are really good, better be careful. Things are gonna get bad. Any questions? What, of all the indicators I showed you this morning, which one do you feel is the most useful? Anybody opine on that? Yield curve? Yield curve, okay. Yeah, it's great. It's nice, it's visual, you can see it easily. That's one of my very favorite tools. I like the unemployment number when we saw the unemployment rolls over because you can put that in the trading station, you can chart it, you can see that gives up sell signals. The decennial pattern is helpful for a time period. And 2017, we're going to focus on that as a sell point? Yeah. And look for some fundamental data to confirm the sell point as we get there.